I want you to imagine something with me for a moment. Picture a man, let us call him Richard, 71 years old, retired school teacher, decent pension, Social Security, coming every month like clockwork. Richard spent 40 years being careful. He clipped coupons. He drove his cars until the wheels fell off. He brown bagged his lunch while his colleagues went to restaurants. And Richard saved. He saved and saved and saved and saved until one day he looked at his bank account and saw a number that made him feel safe for the first time in his adult life. $460,000 sitting there in a savings account earning 2.1%, and Richard sleeps well at night because of that number. He tells his daughter the money is safe. He tells his son he is being responsible. He tells himself he earned this security and he deserves to protect it. Now let me tell you what Richard does not know: that money is dying. Every single day that money sits in that account, it is being eaten alive by something invisible and ruthless and patient. And Richard, careful, diligent, admirable, Richard is not protecting his life savings. He is slowly destroying it, and the tragedy is he will not find out until it is too late to do anything about it. I have lived 93 years on this earth. I have watched markets collapse and recover and collapse again. I have watched men build fortunes, and I have watched men turn fortunes into rubble. And the thing that breaks my heart, the thing that has broken my heart more times than I can count, is not the men who took wild gambles and lost. It is the Richards of the world. The careful ones. The ones who did everything right for 40 years and then in the final chapter of their financial lives made one enormous quiet mistake. They confused safety with security, and those two words are not the same word. They're not even close to the same word. Pay close attention, because what I am about to tell you applies to every person watching this who is 60 years old or older and has money sitting in a savings account or a money market or a pile of certificates of deposit earning 3% while they congratulate themselves for being prudent. This is not prudence. This is a slow-motion catastrophe, and I am going to show you exactly what to do instead. Let us begin. Today, I am going to walk you through what I call the Late-Stage Capital Framework 5 specific shifts in how you think about and deploy money when you are in the final third of your financial life. These are not complicated ideas. I want to be clear about that up front. The math is simple. The logic is obvious, and anyone with a functioning brain can understand every single word I am about to say, but understanding is not the problem. The problem is something older and deeper than understanding. The problem is fear. Specifically, the kind of fear that disguises itself as wisdom. The kind of fear that says, I have worked too hard to risk this money now. The kind of fear that feels so reasonable and so responsible that most people never question it. Most people will hear everything I'm about to say and nod along and then go home and do nothing. I know this because I have been watching people make this mistake for 7 decades. But some of you, a few of you are going to hear this and actually change something. And for those people, this video may be the most important 45 minutes of your financial life. So let us get into it. The first shift I want to talk about, I call the inflation confession. Here is the dark truth that no bank will ever say to your face: when a savings account or a CD earns 3% in a world where inflation runs at 4%, you are not earning 3%. You are losing 1% every year silently, invisibly, without a single transaction, without a single market move, without anything dramatic happening at all. Your purchasing power is being confiscated. Now I want you to understand what this actually means in human terms, not in abstract percentage terms. Let us say you have $400,000 today at 3% and a 4% inflation environment. You lose 1% of real value per year. In 10 years, that $400,000 buys what $360,000 buys today. In 20 years, it buys what $320,000 buys today. You have done nothing wrong. You have made no bad decisions. You have simply sat still. And sitting still in an inflationary environment is the same as walking backwards. Now, some of you are saying, but wait, I need that money to be safe. I am 65 years old. I cannot afford to lose it. And I understand that instinct completely. I do not dismiss it, but I want you to examine what you actually mean when you say the word safe. Because here is the question nobody asks. Safe from what? Safe from a stock market correction? Yes, your cash is safe from that. But safe from inflation? No. Safe from longevity risk? The risk that you live to 90 and run out of money? No. Safe from the psychological corrosion of watching your purchasing power erode year after year? No. The savings account feels safe because the number does not go down. But the number going down is not the only way to lose money. It is not even the most common way. The most common way people in their 60s and 70s lose money is by keeping it in instruments that guarantee a return that is lower than inflation. They do not lose the number, they lose the value. And value is what buys groceries. Value is what pays the medical bill. Value is what funds the decade of retirement you have not yet lived. Here is your assignment for this first shift. Tonight I want you to find out exactly what your savings accounts, CDs, and money market accounts are currently earning. Write down the number. Then subtract the current inflation rate from that number. If the result is negative, and for most people reading this, it will be negative, I want you to sit with that number for 5 full minutes. Do not immediately pick up your phone. Do not immediately start Googling solutions. Just sit with the number, because until you feel the reality of what is happening in your gut, not just your head, you will not have the motivation to change it. The first step to solving any problem is an honest diagnosis. And most people in their 60s have never honestly diagnosed what their cash is actually doing to them. The second shift I call the time horizon illusion. And this is the one that I believe causes more damage than any other single misconception in late stage. Financial planning. Here's the conventional wisdom. The older you are, the less time you have, therefore the more conservative you should be with your money. Sounds reasonable. Sounds so reasonable that almost no one questions it. I am here to question it because the conventional wisdom is based on a deeply flawed assumption about time. When a 65-year-old says, "I do not have time for the market to recover from a downturn," they are implicitly assuming that they are going to need all of their money very soon. But are they? Let us do some math. The average American who reaches age 65 today has a statistical life expectancy of approximately 83 years. That is 18 more years, 18 years, 18 years, 18 years. A 65-year-old who puts money into a diversified portfolio of quality businesses and does not touch it for 10 years, which is perfectly reasonable if they have enough income from pension and Social Security to cover their expenses, has a time horizon that is longer than many 30-year-olds who are investing their first paycheck. But more importantly, let us talk about what actually happens over those 18 years with different approaches. Money sitting in cash losing 1% annually to inflation. Over 18 years, you lose approximately 16% of your real purchasing power. Money invested in a simple diversified portfolio of quality businesses returning 7% annually. Over 18 years, you more than triple your money in real terms. The difference between those two outcomes is not a matter of risk tolerance. It is a matter of mathematical literacy. I want to be precise here. I am not telling a 65-year-old to put their entire life savings into speculative technology stocks. That would be foolish, and I would never say it. What I am saying is this. If you have 12 months of living expenses and liquid cash, and I will explain exactly what to do with that cash in a moment, then the rest of your money has a time horizon that is almost certainly longer than you think. And money with a long time horizon belongs in productive assets that can grow, not in a savings account that cannot. Here is what I want you to understand about how I think about time. I have always said that my favorite holding period is forever. Not because I am reckless, because I have seen what quality businesses do over long periods of time. I bought Coca-Cola in 1988. I have not sold it. That investment has returned me something in the neighborhood of 20 times my original money. Not because I am a genius, because I understood that a business that sells a product billions of people want every single day for decades on end does not need me to micromanage it. It needs me to leave it alone and let time do its work. Time is not the enemy of the 65-year-old investor. The misuse of time is the enemy. Treating a potential 20-year time horizon as if it were a 2-year time horizon is one of the most expensive mistakes a person in their 60s can make. Here's your assignment for this second shift. Take a piece of paper and write down 3 numbers. First, write down your current age. Second, write down the age at which your parents or grandparents died. Whichever parent died, live longer. Third, write down the number of years between those 2 ages. Now subtract your current age from that longer-lived ancestor's age. That is your realistic time horizon. For most people watching this, that number is going to be somewhere between 15 and 30 years. 15 to 30 years. That is not a short time horizon. That is a long time horizon dressed up in a body that feels old. Invest accordingly. 2. The third shift I want to discuss, I call the bucket architecture. This is the most practical section of everything I am going to tell you today. And I want you to understand it clearly because this is the mechanism, the actual structure that allows you to invest for growth without losing sleep at night. Here's the problem with telling a retiree to invest in the stock market. They say, but what if it crashes? What if I need the money and the market is down 40%? And that is a legitimate question. It deserves a real answer, not a dismissal. The answer is this. You structure your money so that you never have to sell an investment at a bad time. Here's how you divide your money into 3 buckets. The first bucket is your security bucket. This holds 24 months of living expenses. Everything above and beyond your guaranteed income from pension and Social Security in pure liquid cash. High-yield savings account, money market, short-term treasuries. This money is not meant to grow. This money is a moat. It is the bulletproof vest that protects. Everything else, its job is to let you sleep at night and to ensure that if the market drops 50% tomorrow, you do not have to sell a single share of anything. You live on this bucket. You refill it over time. But you never reach into the other buckets to fill it during a downturn. The second bucket is your income bucket. This holds 5 to 10 years of projected withdrawals invested in dividend-paying stocks, bonds, and other income-producing assets. The goal of this bucket is not explosive growth. The goal is steady, reliable income that arrives in your account whether the market is up or down. When your favorite business pays you a dividend every quarter, you do not care what the stock price is doing today. You care that the business is healthy enough to keep paying. This bucket funds the refilling of bucket 1. The third bucket is your growth bucket. This is where your remaining capital, the money you genuinely do not expect to need for 10 or more years, goes to work in quality businesses with long runways for growth. This is the bucket that fights inflation. This is the bucket that builds your legacy. This is the bucket that compounds quietly in the background while you live your life. Now, here's the beautiful thing about the 3-bucket architecture. When the market crashes, and it will crash, it always crashes. I have lived through 14 of them. You do not panic. Why? Because you have 12 to 24 months of cash in bucket 1. Because bucket 2 is still paying you dividends? Because you have no reason to touch bucket 3. The market can be down 30% and your life does not change by a single day. You wake up, you have your coffee, you read your newspaper, and you wait. And eventually, every single time in the history of modern markets, the market recovers. It has never not recovered. Not once. The people who get destroyed in market crashes are not the people who invested. They are the people who invested without a plan. They are the people who had no cash buffer and had to sell quality businesses at the worst possible prices to pay for a medical bill or a roof repair or simply to eat. The bucket architecture exists so you are never that person. Here is your assignment for this third shift. Draw 3 circles on a piece of paper. Label them: security, income, and growth. Now write down every dollar you currently have and put each dollar into the bucket where it actually belongs today. Not where it should be. Where it is for most people doing this exercise for the first time, it is a revelation. Almost everything is in bucket 1 or in instruments that function like a bad version of bucket 1 but without the liquidity. Almost nothing is in bucket 3. You will see the imbalance immediately. And once you see it, you will understand with perfect clarity what needs to move and why. Shift, I call the legacy leverage point. And this one I want to spend some time on because it involves a psychological shift that is harder than any of the financial mechanics I've described. Here's the truth about why most people in their 60s hoard cash. They tell themselves it is about safety. They tell themselves it is about being responsible. But underneath those rational explanations, there's usually something older and more primal. There is fear, and underneath the fear, there is often a story. A story about what money means. For many people who are now in their 60s, the formative money experiences of their lives happen during times of scarcity. The 70s, with their oil shocks and their stagflation. Parents or grandparents who lived through the Great Depression. The 2008 financial crisis hitting right at the moment they were supposed to be approaching the finish line. These experiences do not just create preferences. They rewire the brain. They install what I call a scarcity operating system, a set of automatic responses to money that made perfect sense in a world of scarcity, but become actively harmful in a world of relative abundance. The man who grew up watching his father worry about the electric bill will hoard cash even when he has $400,000 in the bank? Not because hoarding is rational, because the neural pathways of scarcity do not update themselves automatically just because the balance sheet changes. You must update them manually. You must do it consciously. And one of the most powerful ways to do that is to shift your mental relationship to the money itself. Here is a reframe I want you to try. Stop thinking of your money as your money. I know that sounds strange, so let me explain. Every dollar you have represents a unit of human energy, your energy, exchanged over decades of labor that has been converted into a portable form. But money is also a seed, and seeds are not meant to be stored in a jar on a shelf where they slowly lose their viability. Seeds are meant to be planted when you plant a seed in good soil and give it time. And water, you do not get the seed back. You get a tree, and a tree produces fruit not just for you, but for everyone who comes after you. Your children, your grandchildren, the causes you care about, the community you built your life inside of. Now, I want to give you a very specific number. If $100,000 today and you invest it in a simple diversified portfolio returning 7% annually, and you never add another dollar to it, in 20 years you will have approximately $1.5 million. $1.5 million from $400,000 simply by giving it time and a reasonable rate of return. If instead you keep that $400,000 in a savings account earning 2.5% for 20 years, you will have approximately $650,000. The difference between those two outcomes is $850,000. $850,000. That is not the difference between rich and comfortable. That is often the difference between leaving your children something meaningful and leaving them nothing. That is often the difference between funding your grandchildren's education. And not that is often the difference between having the financial resources to handle a decade of medical costs in your 80s and running out of money before you run out of life. The legacy leverage point is this. The decisions you make today about how to deploy your capital are not just decisions about your retirement. They are decisions about everyone who comes after you, and that reframe from my money to a living system that serves my family and my values is often the psychological bridge that allows people to move from hoarding to deploying. Here is your assignment for this fourth shift. I want you to write down 3 names, the 3 people in your life whose financial future you care most about. Your children, your grandchildren, a cause that matters to you, whoever they are. Write their names down. Now, next to each name, write one thing that an additional $200,000 or $500,000 or $1 million would change in their life. Make it specific, not just something vague like financial security. Write down the actual thing. My granddaughter could go to college without debt. My son could start the business he's been afraid to start. My church could build the community center they've been planning for 15 years. Now ask yourself this. Is hoarding cash in a savings account that loses to inflation serving those people, or is it failing them? The fifth and final shift I call the simplicity supremacy. I have spent 70 years in this business. I have met the smartest people on earth. I have seen hedge funds run by Nobel Prize winners blow up spectacularly. I have seen mathematicians with PhDs in quantitative finance lose everything on strategies so complex that nobody could explain them in plain English. And I have seen ordinary people with no financial training, no advanced degrees, no Bloomberg terminals build generational wealth through an approach so simple it embarrasses the professionals. Here's the truth about complexity. Complexity in investing serves one purpose and one purpose only. It makes money for the person selling you the complexity. The financial industry is a very good industry run by very smart people who have a very strong incentive to convince you that you need them. You need their sophisticated products. You need their active management. You need their expertise to navigate the treacherous waters of the modern financial markets. You do not need any of it. Here is what the research actually shows, not what the financial industry's marketing department shows, but what decades of rigorous academic research shows. Approximately 80 to 90% of actively managed funds underperform their benchmark index over a 10-year period, 80 to 90% after fees. The people charging you 1% or 2% of your assets every year to beat the market are statistically, overwhelmingly, almost certainly not beating the market. They are beating you. They are taking your money for a service they are almost certain not to deliver. Now, for a 65-year-old with a reasonable amount of money, the fee difference between an actively managed portfolio and a simple index fund portfolio can represent tens of thousands of dollars over a decade. Real money that belongs in your growth bucket, not in the pocket of someone who tells you that the market is complicated and you need their help. Here is what I have actually done for most of my investing life. I have bought businesses I understand at prices that make sense. I have held them for a very long time. I have done very little. That is it. When people come to visit me in Omaha, they sometimes expect to find a trading floor, screens everywhere, phones ringing, the frenetic energy of someone managing enormous complexity. Instead, they find an old man reading annual reports, reading history, reading about businesses and the people who run them. The edge is not in doing more. The edge is in doing less, but doing it with more conviction and more patience. For someone in their 60s who does not want to spend their retirement analyzing balance sheets, there is an even simpler version of this A broad market index fund that owns the 500 largest businesses in America. Low cost, we are talking expenses of less than 0.1% per year. Rebalanced once a year, that is it. Over any 20-year period in the history of this country, that approach has beaten the vast majority of professional money managers. Vast majority. The simplest possible approach, patiently executed. That is simplicity, supremacy. The understanding that the most powerful investment approach available to you is also the most boring one. Boring does not mean ineffective. Boring means you are not paying someone for unnecessary complexity. Boring means you are not making emotional decisions based on short-term market noise. Boring means you are letting the extraordinary long-term engine of American business do what it does best. Great value over time. Here is your assignment for the fifth shift. Pull up a statement for every investment account you currently have. Look at the expense ratios on every fund you own. If any of them are above half of 1% per year, I want you to ask a very specific question. What evidence do I have that this fund's performance justifies this cost? Not what your financial advisor told you, not what the fund's marketing materials say. What does the actual track record show, net of fees, compared to a simple index? For most people doing this exercise, the answer is going to be uncomfortable. And that discomfort is worth sitting with, because acting on that discomfort could be worth more than any single investment decision you make this year. Now, I want to step back from all of this financial mechanics. I want to step back from buckets and allocations and expense ratios. And I want to talk to you about something that matters more than any of it. I have sat at the bedsides of dying men. Not many, but enough. Men who had done everything right financially. Men who had followed something like the framework I have just laid out and built real substantial wealth. And I want to tell you something they told me in those final conversations. Not one of them talked about their investment returns. Not one of them expressed regret about being too conservative with their asset allocation. What they talked about was time. The time they had spent in the office instead of at the dinner table. The conversations they had not had. The trips they had not taken. The grandchildren they had watched from a distance instead of holding in their arms. One man, a man I had known for 30 years, a genuinely brilliant investor, told me near the end that he had managed his portfolio like a work of art and his relationships like an afterthought, and he had gotten exactly what he had optimized for, a magnificent portfolio. And a magnificent loneliness. I think about that man often. I think about what it means to reach the final chapter of your life with a number in your bank account that you can be proud of and nobody to call who truly loves you. Money is a tool. It is an extraordinary tool. It is an extraordinary tool. It gives you freedom and options and the ability to help the people and causes you care about, but it is a tool. It is not the destination. The destination, if I have learned anything in 93 years, is the quality of the relationships you build and maintain over a lifetime. The inner scorecard. Not how the world sees you, how the people who know you best see you. How the people who know you best see you. Whether you showed up, whether you were present, whether you gave your time, which is the only truly non-renewable resource any of us has, to the things and the people that actually matter. The rocking chair test that I often applied to decisions is this. Imagine yourself at 95 years old sitting in a rocking chair on a porch, somewhere looking back at the totality of your life. The version of you at 95 is not thinking about whether you left your money in a savings account or moved it to a diversified portfolio. But that version of you might be thinking about the decade of retirement you had the resources to fully Live the trips you took, the time you gave your grandchildren, the freedom you had to show up for the people you loved, versus the decade you spent anxiously watching a savings account balance and worrying that you had not done enough good financial decisions. Create freedom, creates time, is the only thing you can give to the people you love that truly cannot be replaced. Get the money right so that you have the freedom to get everything else right too. That is the whole game. Everything I have described today, the inflation confession, the time horizon recalibration, the bucket, architecture, the legacy leverage point, the simplicity supremacy, all of it exists in service of one thing: the freedom to spend your remaining years fully alive, not anxiously hoarding, not working when you should be resting, not walking a number in a savings account while the people you love grow older without you, alive, present, free. Sick Dram. Let me bring this home. Today we covered 5 shifts that every person 60 and older needs to make. The inflation confession, the recognition that cash losing to inflation is not safety, it is a slow confiscation. The time horizon illusion. The understanding that your investment runway is almost certainly longer than fear tells you it is. The bucket architecture, the practical structure that lets you invest for growth without the anxiety of needing to sell at a bad time. The legacy leverage point, the psychological reframe that moves you from hoarding to planting, from protecting your money to multiplying your impact. And the simplicity, supremacy, the evidence-based conviction that the most powerful investment approach is almost always the simplest one. None of this is complicated. All of it is hard, because it requires you to confront a fear that has been with you for decades. It requires you to update an operating system that was installed in you during a time of scarcity and has not been revised since most people will watch this video and feel it deeply and do nothing. Do not be that person. Do not let this be one more piece of information you carry around without acting on it. Information without action is useless. Wisdom without execution is vanity. You have worked too hard and waited too long to let fear disguised as prudence rob you of what is rightfully yours. Do it today. Not next week, not after. You talk to your brother-in-law about it today. Move one thing. Start with the assignment from the first shift. Find out what your money is actually earning in real terms. Do it today. The door is open. It has always been open. That is all. Thanks for watching.